hope you've been keeping well and safe in these times. My name is Chavi Mudgal and I run strategy at InCred. And on behalf of InCred Group, I welcome you to this conversation with Ms. Punita Kumar Sinha on global economy and markets outlook. Punita is chairperson of InCred's AMC, and she's a globally renowned expert in equities. She's on the board of governance of the CFA Institute and also on the board of several companies such as Infosys, Lupin, JSW Steel, and the Blackstone Embassy REIT. Welcome, Punita.
Hello, everybody. It's a pleasure to be here today and to discuss the global markets and economy with all of you.
Punita, we had done a webinar with some of our clients in early April, just around the time when, COVID had really hit the Indian economy. And there were then many concerns on how long the crisis will last. How do you think the economic recovery has been globally and in India?
So Chavi, I'll talk first about the markets because when we spoke in April, at that point, the markets had really fallen off a cliff. Like they were down about 30% for most markets. And there was no visibility on the stimulus packages by various governments. Some governments had already given some stimulus packages, which were quite sizable, but India still hadn't released its full stimulus package. Also, we knew much less about COVID than we do today. So there was a lot more uncertainty, a lot more volatility, and a lot more risk aversion, and therefore markets had fallen quite a bit. Now, in previous crises, whether it was 2008, 1998, 99, and the Asian financial crises, the markets had fallen about the same or more, but they took a longer time to come back. This time has been different. Markets have recovered almost all their losses and back pretty much to the pre-COVID levels. So if you see from April to now, I think the S&P is up about 50% and the Nifty is also up about 50%. So we've seen a very sharp recovery from the bottom, which is unlike most other crises. However, if you compare it to some of the smaller crises we've had, which are health related, the pandemics that we've had in the past, like the SARS or the Ebola, the markets had fallen then too, but had also sharply recovered. Markets are generally leading indicators and economies follow. So we'll talk about the economies in a bit.
So coming to that point on economies, how do you think, the US and the India economies are going to do in the next 6 to 12 months? And different economists have given various forecasts in terms of what will be the shape of, the curve of growth. It could be U-shaped, so on and so forth. What are your thoughts on this?
So, the economies are still dealing with the aftermath of the COVID. In fact, COVID is still very much prevalent, and in India, we are seeing cases still rising. So I don't think the economic damage is over, but there have been a few very positive actions by governments all around the world that has helped ease the pain. So for one, of course, the fiscal stimulus has been enormous. It's been more than what we've seen in the past. And even in India, we've had a fiscal stimulus package of about over 10% of GDP. Now that includes the RBI measures. In the US, of course, it's a similar percentage terms, but the economy is a lot bigger and the population is a lot smaller. So per capita fiscal stimulus in the US is really, really quite significant. And so that has really, I think, caused market participants as well as economists to feel more hopeful about how we're going to come out of this crisis. Having said that, the IMF and all the other economists have still been lowering their forecasts for 2020. And we are seeing, whether it was the forecast that was for March for 2020 has come down in June. The June forecast was lower, and the current forecast is even lower than what it was in March. So most people expect that the world economic growth is going to be negative. India is probably going to end up down perhaps minus 10%. Nobody really knows what that number will be. But for 2021, everybody's forecasting a recovery. Now, the magnitude of the recovery Again, I think that number doesn't really mean much at this point because a lot of factors are going to impact the recovery. Um, Already we are seeing unemployment levels, whether it's in India or the US, which had risen very sharply in March and April, come down as a result of all the stimulus packages. In fact, companies in India that I've been talking to are saying that most of their business activity is back to pre-COVID levels, and 80% of the migrant labor is back working in these factories. So economic output is definitely going to improve, but we have lost 1/4 of growth for pretty much the world economy, and that will take some time to totally normalize. Having said that, if you look at Indian IIP, again, that had fallen very sharply. It has recovered quite sharply, still below pre-COVID levels, but it has kind of shown somewhat of a V-shaped recovery, but not back to normal levels. Same thing with PMI in most countries. The PMI levels are still below what they were pre-COVID, but they have shown a recovery. And I think what is also very favorable for global economies has been the low interest rate environment. Interest rates are near zero in the US, and in India, they're at 20-year lows. So there has been not only a fiscal stimulus, there's also been a monetary stimulus, and there's been plenty of liquidity all over the globe. And that's what's really caused the markets to recover as sharply as they have.
No, thanks for that, Punita. I completely concur with your views on how the economies are recovering. But as you know, different sectors have reacted differently, and some sectors like healthcare, for example, have seen an enormous surge in terms of economic activity as well as investments flowing in. So, is there a lot of disparity which you are seeing in sectors from a growth perspective in the next 6 to 12 months?
Well, there has been disparity in the performance of sectors in the markets and also on their own corporate growth side, as well as the business activity, because a lot of factories were shut down. So a lot of companies that were in certain sectors got more impacted than others. Now, IT, of course, has held up quite well globally because of the need for work from home, and technology played a very important role in that. Healthcare sector earnings have also not been as impacted, and the corporate profit globally of the healthcare sector is actually the least impacted from the COVID levels. Again, the sector is going to see a lot more investment as everybody realizes the importance of this sector, and also the need for vaccines and other cures. So this has been an attractive sector, both from the financial market point of view, as well as from the corporate earnings fall has been the least. And of course, the sectors that have been most impacted have been the travel and leisure and consumer discretionary during the COVID, because pretty much all travel and tourism have stopped. And what we've seen is that India's sector growth hasn't been very different than what we've seen globally in terms of the disparity. So it's the same sectors in India that have held up better, which is healthcare, technology, etc. And then the sectors that have been down the most have been energy and financials. So globally, there has been a lot of correlation between the sector performance.
So, Punita, what do you think are the key risks which the economies are facing today? And there have been concerns, as you know, on a second wave of coronavirus coming in. There could potentially be more deaths due to winter months. There's speculation on what will be the results of the approaching US federal elections in November. What do you think are the key risks?
Now, Chavi, we are not out of the woods right now. We are seeing still quite a bit of risks. Now, of course, the first biggest risk that I'm seeing there is the role of China in the world and how various countries are going to deal with it. As you know, obviously, that in India, China, we are having issues on the border and their border disputes. And I hope it doesn't spiral into a war, but that's something that one should keep an eye on. The whole China-US relationship is also under threat. And so if you look at global trade, from what it used to be, the numbers have dramatically declined because there has been a rise of nationalism across all countries. And there also has been this, COVID has also disrupted a lot of supply chains around the world. So there are countries that are looking to insource a lot of production particularly of essential goods, so that they're not reliant on supply chains, and they're also diversifying supply chains. So global trade has taken a hit, and that always affects recovery as well, because trade has been impacted. And then now we have an upcoming US presidential election. Depending on who becomes president, some of these equations could change, some of the policies could change, and so that is also a risk. So I think geopolitical risk is there. Then there's risk of U.S. presidential election, and then also in the economic side, what we are seeing is that this low interest rate, easy money environment is beginning to cause some inflation. Now, inflation is partly because of the easy money and partly because of supply disruptions. But inflation could be a concern, because if inflation starts ticking up, then this easy money is likely to end. And whenever the easy money reverses and interest rates either go up or governments start withdrawing some of the stimulus, then we could also see an impact on the financial markets.
So Punita, in light of all these risks, and you spend so much of time being on the boards and working with several companies, including as part of your endeavor of being associated with the CFA Institute, what do you think companies can do to fare well and be resilient to navigate this type of an environment and emerge as long-term winners?
Surprisingly, the world has adapted quite well to COVID and working from home. And most companies have dealt with it quite well. So, of course, the technology sector has been the best positioned, because they benefited from this whole rise of the need for information and data and technology. So they've done quite well. But when I look around, even the essential good companies, whether it's steel or whether it's chemicals, and the companies that I deal with, pharmaceuticals, they've all pretty much been able to function now, yes, at much lower capacity utilization than normal, but that was one quarter, and most of the activity is back to normal. And I think companies all around the world have had a lot of discussions on COVID, and one of the things that companies are also now increasingly focusing on is a lot more risk management, a lot more focus on controls, cybersecurity, the need for, this could be a longer term trend, and therefore a lot of companies are also thinking about what that means for work from home, what that means for their ability to cut some real estate costs, and a lot more discussions at the board on scenario planning. So I think those are some of the things we are seeing at the company levels and at the board level.
So Punita, coming to equity markets, as you know, they've been doing really well. They've run up quite a bit in India. Do you find these levels, these valuation levels, particularly sustainable? And how do you think of liquidity in the next 6 to 12 months in both India as well as US?
Valuations are definitely looking high to me, because right now markets have been anticipating not only an economic recovery, but obviously a corporate profit recovery as well. And so to some extent, they've run ahead of the fundamentals. And if you look at the valuations of the US markets, they are, at levels that we haven't seen in a while. So they're even higher than almost pre-COVID levels. In fact, US markets are pretty much flat or up year to date, depending on the day. If you look at the Nifty, which is a very narrow segment of the market, also I think valuations are not looking greatly attractive, because markets have run and they're anticipating a recovery, and so their earnings still have to follow. If you look at the mid and small caps, there we do see some more value, because it is a much broader space. There are lots of companies, even though mid and small caps have done quite well in the last 2 months or so. There is, if you look at the unweighted to the weighted market cap index of the NSE 500, it is showing that relative to the larger caps, the mid caps are still historically, mid caps are still, and small caps as well, are looking more attractive compared to the larger cap, based on even the historical difference that we've seen in their valuation. The gap is still there. And so I think there is value, and this is going to be a market which is going to now be very much focused on stock selection, because not all companies have fared equally well in COVID. Some have managed it better than others. In some cases, they've been able to get back to capacity utilization faster than in some other sectors. So there is also some sector impact. And so you have to trade off growth and value. When I look at the markets, they were very momentum-led globally, and this includes US, India, everywhere. Now I think the focus of late has been shifting more to a value, and so people are now, after a long time, now starting to look at value stocks, and because growth and momentum stocks, the valuations have kind of started looking expensive. So this is going to be a stock pickers market, I think, going forward. There is value, but one has to look.
It's very interesting what you're saying, Punita, on small caps and mid caps, because as you know, even from a regulatory standpoint in India, SEBI is now contemplating a big change in the constitution of multi-cap funds, and wants fund managers to allocate at least 25% of the corpus to mid caps and small caps. How do you see this playing out, and what impact do you think this will have on equity markets in India?
Well, having managed a large India fund in the US for 15 some years, I never really had to face this constraint, because the US regulator doesn't put this kind of artificial constraints in terms of that you have to allocate to large, mid, and small caps in equal proportion in a multi-cap fund. In fact, if a fund manager, it is up to the professional manager's discretion as to how they allocate, depending on the mandate of the fund. And if the mandate of the fund is an all-cap fund or a focused fund and is disclosed in the prospectus, then at least in the US, we were not constrained, and we could then allocate based on our judgment. I think the big challenge is going to be that there is no benchmark to compare a multi-cap fund with. If you start forcing them to put 25, 25, 25, there is no index that has 25, 25, 25 in large, mid, and small. So how are you going to compare these managers to a benchmark? And you're not taking into account liquidity. So if a multi-cap fund becomes very large, they won't have the liquidity to put 25% in small caps and another 25% in mid caps, in terms of the liquidity of the underlying companies to buy so many. Of course, it will help mid and small cap stocks perform. Many of them have been neglected for a very long time. Part of the reason you've seen the rally in the last couple of weeks is because if this rule goes through, then there'll be a lot of liquidity that is going to go into the mid and small cap segment. But what it does create is a scenario where PMSs and AIFs start looking more attractive compared to mutual funds, because the PMSs and AIF will not be constrained. So the professional manager is going to be able to use their discretion to decide whether to be in large caps or mid caps or small caps. Whereas in mutual funds, you're forcing the manager. So even though, like, let's look back in March when all the markets corrected, the mid caps and small caps got beaten down more than the large caps. And then as the recovery started, the large caps globally were the first ones to recover. And if you had put these constraints, it would have affected the professional judgment of the manager could not be utilized to navigate through this crisis as they may have done otherwise.
Well, that's all the questions I had for this session. Thank you so much for your time, Punita. And I hope this has been an engaging discussion for all our viewers as well. And we hope to do this on a monthly basis. So if you have any more questions, feel free to write to us at the email ID, which is flashing on the screen right now. And hope to see you really soon. Thank you, Punita.
Thank you, Chavi. And thank you to all our viewers. And look forward to engaging with you next month.